Good evening. Good evening to all of you. My name is Peter Juven. I am the academic dean at the Fletcher School. Steve Bosworth, the dean of the Fletcher School, could unfortunately not make it tonight, so he asked me to welcome all of you. As a matter of fact, I think it's the 5th or the 6th time in a row I've had the pleasure of opening the Karamanlis annual conference, and it's one of the events every year that actually gives me great joy. We are very pleased at Fletcher to see many colleagues from the Greek community and others who are interested in Greece and Europe here with us tonight, and we thank all of you very much for coming. We have amongst others with us here tonight, obviously, our speaker, Charles Dallara, who will be introduced later, but who is also a member of the Fletcher board. We also have here two members of the Karamanlis Foundation board, Dimitris Papadopoulos, who also is actually a Fletcher graduate from '94, I think. You must have been really young. And we have with us as well Kostas Karamanlis, who is the treasurer of the Karamanlis Foundation and also a Fletcher graduate in 2000, the year I arrived here, so I never got to know you as a student. This is the 11th annual celebration of the Karamanlis Center at the Fletcher School since the establishment of the Karamanlis Chair of Hellenic and European Studies. Last year we had our big 10th year celebration, and I think I see many faces here whom I recognize from last year. As a matter of fact, Charles Dallara was supposed back then to be also our speaker, but urgent issues retained him back then in Greece, although we had some phenomenal other speakers at the time, some of whom actually are here today as well. I'm glad to see all of you again as well. So the Fletcher School does remain very proud of having the Kostas Karamanlis Center in our midst. It's important for us that the study of Greece and Europe remains an important part of the Fletcher curriculum, that we bring students from Greece to the Fletcher School through scholarships and so on, that we bring students from the Fletcher School to Greece for internships, research, and so on, that we organize events for scholars, for the Greek community, for anybody who is interested. All of these are an important part of the school, many of which have been made possible precisely by the presence of the Kostas Karamanlis Center for Hellenic and European Studies at the school. By the way, if you are interested in more information on this, I think I was told that there are brochures about that available when you leave, and please do feel free to pick one of these up. Enough introduction now. I think I will now ask Kostas Karamanlis, who, as I told you, apart from being the treasurer of the Karamanlis Foundation and a member of the board of the Fletcher School, is also the CEO of Manitania Shipping. He will actually introduce the chair and the current chair holder to all of you. Kostas, thank you.
Dear Dean, Dr. Dallara McCarley, ladies and gentlemen, I am very happy and deeply honored to be standing here tonight in front of this esteemed audience on behalf of the Karamanlis Chair in Athens, Greece, celebrating one more year of growth and achievement for the Karamanlis Chair in Hellenic and European Studies. It's been 11 years, as you mentioned, Peter, since we first inaugurated the chair back in 2001. During this time, the chair has hosted 7 professors from various fields of social sciences and from different backgrounds. The last one is the current holder of the chair, the distinguished professor Michalis Papadopoulos, who is, I think, spending his 3rd year here at Fletcher. When it comes to the chair, there is much one should be happy and proud of. There have been more than 30 courses offered, both here at Fletcher and at the Political Science Department in Tufts, and the chair has become, I believe, a vibrant hub for the study of modern Greece and Europe. I would like to take this opportunity to thank the school, the faculty, and the staff for the impeccable cooperation we have had all these years, and I would like to pledge our foundation's continuous support for the chair's growth and activities. Seeing Steve Bosworth departing this school at the end of this academic year saddens, I think, all of us. Dean Bosworth has provided the school with vision, wisdom, and a steady hand at a time of great change. Allow me to say, as a non-American, that to me, and I am sure to many others, the Dean embodies the most shining qualities of the American nation. And none among them is greater than a strong, unyielding commitment to public service. Both as a diplomat and as an educator, the Dean has dedicated his life to making our world a better place. His contribution to the chair has been immense, and we will always be deeply grateful for his support. Dear friends, as you know, we're meeting here today at a very difficult time for Greece. The CEO of the National Bank of Greece, a bank that has been a strong supporter of the chair, Mr. Alexandros Tourkolias, had to cancel his participation at the last minute, as the Greek problem remained unresolved last week, and it had to wait until early this morning for a partial resolution. Given the importance of the bank to the Greek economy, Mr. Tourkolias had to stay home to respond to the emergency. He sends his apologies and promises to visit the school soon. Since the start of the crisis in early 2010, the Greek economy has been in a free fall, and the Greek GDP is expected to have contracted by some 20% cumulatively until the end of this year. This is a staggering number. We are no longer talking of a recession, but of a real depression. Today, we Greeks watch, frightened and bewildered, the unraveling of our prosperity and middle-class lifestyle. Who is to blame? Part and parcel of every big crisis is a certain struggle for the control of the narrative of the crisis itself. This struggle is the fiercest in today's Greece, depending on one's ideological predispositions and preferences. For some, it is the fault of unregulated capitalism. For others, it is the making of an overextended state. Even Europe is divided today among competing narratives about the crisis. For the Germans, the problem was the Greek state spending. As a result, the Greeks had to be punished and be made to repent. For the Greeks, and increasingly many others around the world, the problem has been the oppositions of the Germans in sharing the costs of the euro. When turbulence hit the international financial markets, the Greek economy was the weakest link and the most vulnerable prey in the eurozone. The response did not prove effective. The initial emphasis on reducing the deficit was appropriate given the unsustainable large budget shortfall. Continued austerity, however, has proven to be counterproductive, since it undermines economic growth and reform. And this is what Greece needs desperately today. Structural reforms are the only pathways to economic growth. The Greeks have made enormous sacrifice to overcome the crisis, but it is clear today that further assistance is needed. After two massive bailouts and a debt restructuring scheme, little progress has been made in order to create growth prospects. The combination of a very strict set of fiscal austerity measures and a credit crunch drove many southern European countries into a recession that was self-inflicted. In the case of Greece, these policies have plunged the country into a recession of near Great Depression dimensions. The paramount precondition for things to start changing is the restoration of confidence that has been shattered as a result of the persistent fears of a Greek exit from the euro. I think that it is time for the rich nations of Europe, led by Germany, that has benefited the most from the euro, to follow Charles Dallara's advice and the example of private lenders around the world who forgave a large part of Greek debt, incurring substantial losses. If the Greek people and the private savers who had bought the Greek public debt in the past have paid their share, it is probably now high time for the Northern Europeans and the Germans to pay their share, to contribute their share for the stabilization of the Eurozone and consequently of the world economy. Thank you. I would like to ask Dr. Psalidopoulos
I am really humbled to be able to address you for the third consecutive year and welcome you to today's event. I'm going to speak a little bit about older times, times associated for the most of us with the successful Olympic Games of 2004. In 2006, Greece could beat the United States, the Dream Team, in Tokyo and win second place in world basketball. But these are times that belong to the past right now. So let me remind you that upon entry to the Economic and Monetary Union, Greece enjoyed a period of macroeconomic stability, declining interest rates, about 10 percentage points, only in the year of entry, the absence of exchange rate uncertainty, which had plagued Greece in the past, and strong economic sentiment. The above factors, compounded by an international environment characterized by low-risk aversion and abundant liquidity, fueled a favorable feedback among rising spending, improving expectations, and high credit demand. This translated into a steadily rising trend in profitability, asset valuations, and disposable income. The relatively low level of private sector leverage at the time of Greece's entry into the EMU, together with a sizable bank deposit base, provided sufficient margin for the credit expansion, and in fact, Greece was characterized by the lowest loan-to-deposit ratio in the euro area at the beginning of the decade. But things have changed, and however, before changing, let me add that in this environment of strong economic growth, averaging 4% in real terms over the period 2000 to 2005, the effective fiscal constraints were extremely loose. Indeed, the interest cost of the sovereign debt was very low, about 80 points over the German Bund on average, and had indeed dropped to about 20 points in the first quarter of 2006. Thus, a persistent fiscal deficit was not alarming at that time, as low interest rates combined with nominal GDP growth maintained sovereign debt on a slightly declining path as a percentage of GDP. More worrisome was the fact that the high nominal GDP growth also reflected wage and price inflation that was consistently exceeding the euro area average. The concurrent rising external imbalances reflected in the rising level of the current account deficit were ignored at that time within the warm comfort of the currency union. But behind the surface, as I indicated, of relatively resilient growth and superficially sustainable debt dynamics, there were several underlying tensions that became increasingly evident following the eruption of the international financial crisis in 2008. When the veil of demand-based growth was removed, following the hard landing of the international economy and rising risk aversion, the extent of Greece's imbalances, especially its fiscal imbalance, were revealed in their fullness, especially as Greece began the crisis with a large absolute level of public debt at the level of 100% of GDP. The credibility of the country received a further blow when in late 2009, the fiscal data for 2009 and 2008 were found to significantly understate reality. Specifically, the journal government deficit for 2008 was revised upwards to 7.7% of GDP, while the estimate of the deficit for 2009 was raised from 3.7% to 12.7% to finally reach 15.6%. And similarly, the level of general government debt was also revised from 115% to 126%, and the projection for 2010 to an astounding 140%. And in the same time, the current account deficits was near an all-time high of 15% of GDP. Now, this picture of the country's macroeconomic state shocked the international markets. It was only a matter of time before the country lost access to market funding, and it was April 2010. Now, Greece was facing and still faces an unprecedented dual policy problem, the actual size of which was only later understood. The need to rapidly reduce a large fiscal imbalance so as to regain access to market funding, while at the same time reversing large losses in competitiveness. Solving these two problems simultaneously is very difficult because they work against each other. Indeed, they created much larger than initially anticipated challenges and inevitably resulted in the need for large debt relief. And as you all know, this was done with the PSI agreement. Now, the man in charge is today with us, Dr. Charles Dallara, whom I warmly welcome. Dr. Dallara holds a BA in economics from the University of South Carolina, a Master of Arts and a Master of Arts in Law and Diplomacy from the Fletcher School, and a PhD from the Fletcher School. In his distinguished career, he has been alternate executive director at the IMF, Deputy Assistant Secretary of the Treasury for International Monetary Affairs, Senior Deputy Assistant Secretary of the Treasury for International Economic Policy, US Executive Director of the International Monetary Fund, Assistant Secretary of the Treasury for Policy Development and Senior Advisor for Policy to the Secretary of the Treasury. He has been a Managing Director with JP Morgan, responsible for Eastern Europe, the Soviet Union, former Soviet Union, Middle East, Africa, and India. And since 1993, he is the Managing Director of the Institute of International Finance. I welcome him very much and ask you to listen to what he has to say, for he hasn't spoken very much to Greek or Hellenic American audiences, or any audience, I think. So what he has to say will be closely watched by every one of us. Charles, please.
Thank you very much, Michaelis, for those kind words of welcome. Indeed, it is a pleasure and an honor to be with you here tonight. As I think was mentioned earlier, I had hoped to be a speaker during last year's annual lecture of the Karamanlis Chair, and unfortunately was occupied in Europe dealing, perhaps ironically a bit, with the Greek debt problem. I missed the 10th anniversary, which included a bigger celebration for which I feel somewhat deprived, because I understand it was an excellent program. But I'm really pleased and honored to be with you here tonight. Thank you, Dean Uven, for your words of introduction and for being here on behalf of Dean Bosworth and the school. As a vice chair of the board, I'm also very much indebted to the Karamanlis family and want to express my appreciation to Kostas and his colleagues and family members for their strong continuing support for this special chair, now in its 11th year. Chairs such as this are so important to the broader array of activities with which Fletcher engages the minds of his students. And on occasions like this, not just students, but broader members of the community. It's a special privilege for me to be speaking tonight to many members of the Hellenic American community in the Boston area, because, as Michaelis has said, I have not had many opportunities to do that. Last year, I felt like I was on a perpetual cycle of trains and planes, not buses, but I might have been between Athens, Paris, Brussels, Berlin, Rome, trying to sort out some aspects of the Greek debt problem. But if I have been able to make a modest contribution to solving Greece's debt problems, it is because, in no small part, I learned during a few years here at the Fletcher School that there are no pure economic problems in today's world. There are no pure political problems. There are no pure environmental or human problems. They're woven together with layers of complexity. And you begin during a Fletcher education to appreciate the many dimensions of any problem you're trying to solve. If I had approached the solution to Greek debt strictly from a financial point of view, I'm sure I would have ended up at a very different place. And it is for that reason tonight that I'm appreciative of the chair which we honor here, a chair that is in honor of a towering figure in Greek and European history. It's worth just reflecting for a moment on the pivotal role that Konstantinos Karamanlis played in Greek and European history. In fact, for those of you, and many of you probably know more about him than I do, for those of you familiar with this towering figure, you will realize that there was virtually no other European leader who spanned the entire half of the 20th century. There were the de Gaulles, the Adenauers, the Erhards. There were the Giscards and Kohls. He spanned both of these generations of leaders and was, in many ways, the father of modern democracy in Greece. I happen to have lived in Greece for 2 years as a young man. It was not a glorious time for Greek democracy, 1970 to 72. I was a young military officer there. We were not welcomed by the entire Greek community, but most Greek citizens were happier to have American military there than they were, as you will understand, Greek military running the country. When that 7-year period of military leadership came to its demise, Mr. Karamanlis was ready to lead the country back toward democracy. And I think he did so with a sense of perspective and balance that many politicians could learn from today, putting behind him and putting behind many in Greece old competitions among political parties and trying to heal the wounds of this difficult period. Of course, during that time I was in Greece, one could feel a sense of discomfort, but one could also sense, and I was privileged to learn about the vibrancy, the energy, the entrepreneurial skills of this country. As a young officer, I was found to be responsible for a motor wellboat which ferried the other officers from the ship in Piraeus Harbor into the shore, and the motor wellboat was broken. And I had many unhappy officers wanting to get to shore to enjoy an evening in Athens who could not. I was told that the government shipyard in Piraeus was backed up for 2 weeks, and they couldn't do a thing for us. So I resorted to my first experience with Greek entrepreneurialism, took the boat in, towed it in with another boat, found a repairman running his own little shop in a corner of the harbor who agreed within 24 hours to repair it for what at the time seemed like a fairly small amount of drachma. Not only did he do a good job, which got me off the hook, but he generated a lot of ongoing business, because when we would come back to Athens for many different repairs, the large repairs had to go to the governmental shipyard, but the small repairs went to this Greek shipping statesman, as you might call him. Before I dive into today's Greek debt problems, I'd like to spend a few moments, and I'll be brief, but I think it's important, just as we benefited from Michaela's very constructive and balanced recent history of the Greek economy leading into this crisis. I think it's important to see for a moment the global context. The global context is one in which the Greek economy has been trying to ride through a storm for the better part of 5 years. Now, you can certainly argue that the Greek economy was not terribly well prepared to ride through this storm, and we know, and I will talk a little bit about the many weaknesses, structural deficiencies, mismanagement of fiscal positions of the Greek economy. But Greece did not create this storm. This storm was the result of a multitude of factors that erupted first in 2007 and then erupted with tremendous force, creating a vast global recession in 2008. Poor risk management by the firms that I represent, the leading banks and insurance firms of the world, inadequate regulation of those firms, uncoordinated government policies that allowed large imbalances to grow in the global economy, inefficient economic policies in key capitals of the world. These were among the seeds of what led to the explosion of the world economy in 2007 and 2008. And of course, the nearly fatal decision to allow Lehman Brothers to fail, which I would characterize as, we're only 12 years into this century, but I have a good sense that as some of you were fortunate enough to approach the end of this century, that that'll still rank among the top 5 worst policy decisions of the 21st century, allowing Lehman Brothers to go under, because it took the world economy with it. Now today, 5 years later, we're still trying to reassemble a pattern of sustained global growth. We did have some recovery. You've seen it here in this country. You've seen it certainly in China, in Latin America. But the recovery has not gained the altitude or momentum that is needed. Here we're still hampered by a weak housing sector, by a business community that seems hesitant to invest, in part because they're not confident that the consumers will be there for their products, both global consumers and American consumers, but in part they're hesitant to invest because of the inability of our political leaders in this country to find ground for compromise on the fiscal challenges we have. And I don't just mean the fiscal cliff debate that you see and read about every day, which is looming on the near horizon. I'm talking about the longer-term fiscal challenges, which could, if not resolved, make the Greek crisis look like a walk in the park for this country and the world economy. Yes, it may be 20 years down the road, but let's not fail to recognize the severity of the fiscal problems which we face. Some of what we're struggling with today is an inefficient banking sector trying to recover its rhythm globally, but hindered, in my view, by an excess swing of the regulatory pendulum. Was more regulation needed of the banking community? Absolutely. Better risk management is a key going forward, and regulation needs to ensure that that happens. But unfortunately, as often happens, the politicians in the US, the UK, and other countries have decided to swing the regulatory pendulum so far that it is making it difficult, particularly for banks in Europe, to extend credit that can fuel the recovery. Today, of course, we do see signs of recovery again in some emerging markets. China is showing renewed signs of growth, as are key Latin economies. But China is saddled with a whole host of challenges, and it is not at all clear as we stand here in November in 2012 that this new set of leaders that have been chosen by the Communist Party in China will be able to push through a strong and convincing reform program that will revitalize and transform that economy, because it's clear today that the Chinese economy that we see today is not prepared for the 21st century. It was a great economy for the last quarter of the 20th century, almost the perfectly positioned economy for 1985 to 2010, but it is not prepared for the 21st century. Coming to Europe and Greece for a moment, because I think it is clear that the broader global landscape is a very challenging one. It's clear that the Greek crisis has been a catalyst for a broader reassessment of the viability of the Eurozone. As I see many of the recent events, it makes me wonder just how much progress we really made. And yet, as I stand here, I do think that Greece and the Eurozone have made meaningful progress in trying to forge a path forward out of an extraordinarily difficult set of circumstances. Greece did not create the Eurozone. It was proud to be an early member of it. And unfortunately, as we know, Greek economic policies since the creation of the Eurozone have not been fully compatible at all with sustaining a competitive position in a currency bloc. But a serious flaw developed at the onset of the creation of the Eurozone when it was agreed, despite the initiatives of former Chancellor Kohl and many others, to blend a common currency with a unified fiscal policy, despite those common dreams articulated some 20 years ago. Agreement was not reached on a common fiscal foundation, and so you had this structural flaw of a common currency without the necessarily complementary structure of a common fiscal policy. Indeed, since that time, and since the eruption of the market's awareness of the severity of the Greek problems, and mind you, these were markets and investors who poured money into Greece for the better part of a decade on the unfounded assumption that Europe would stand behind all of the credits to Greece, and on the unfounded assumption that they no longer had to engage in sovereign risk analysis to understand the underlying creditworthiness of the Greek economy. When I guided and helped led the creditors and investors through this very difficult debt negotiation of the past year and a half, there were many, many times when the investors and the creditors, as you might imagine, resisted mightily the idea that they would have to take huge losses on their exposures to Greece. Because these were credits they had extended on the assumption that there was no fundamental credit risk involved. But it became evident some 3 years ago that there was vast sovereign credit risk involved. And it became evident some 2 years ago to me and a handful of others involved in this, that there would need to be a major reduction in the private holdings of Greek debt, a major write-off. And at times, the most difficult part of this negotiation was not just trying to find a path forward with Greek authorities and with German and Euro authorities, but convincing the creditors themselves that they had to let go of something that they had believed was of great value. There are, however, contrary perhaps to popular and conventional wisdom, some pretty smart people running the banks and insurance and pension funds of Europe. And the men and women in charge ultimately recognize that for the future of Greece and for the future of Europe, they would have to give up 75% of the value of their claims. This created a huge window of opportunity for Greece, writing off 107 billion euro at one moment in March earlier this year, and then restructuring another 60 to 70 billion over a 30-year time horizon, giving Greece decades to pay it back, and charging very concessional interest rates. Unfortunately, as we stand here today, half a year after that agreement, the benefits of that new window of opportunity have not been seized by Greece. And that is largely a function, in my view, of two factors. First, there is the reality that Greece had to undergo a difficult set of elections to find its way from a technocratic government to new political leadership. And I think that we have to pay tribute to the governments that have guided Greece through these difficult few years. In fact, since the spring of 2004, when Eurostat stood up and said, Greece, your numbers don't add up, the Greek governments have been scrambling to try to come to grips with what obviously had been a rather seriously mismanaged macroeconomic situation in, I would say, the preceding 15 to 25 years. Since that alarm bell went off in 2004, and markets should have awakened at that time, but they didn't. They kept pouring money into Greece. Many of the creditors whose claims I had to convince them to write off were put on their books not in 2000 and 2001. They were put on their books in 2005 and 2006. Hardly any excuse for not realizing the severity of the problems at that point. The government since 2004 had tried to stabilize a ship that frankly had been hit below the waterline by years of poor economic policy and a growing size of government which began to intrude in so many parts of the Greek social and economic fabric. The reality is that over the last few years, Greece has done quite a lot to forge a new path forward. But it was unfortunate, but reality, that Greece needed to move through these two difficult elections in order to find a new coalition government. The first in, I'm tempted to say the first in many decades, but maybe the first ever that had real political authority. I know there has been a technocratic government or two over the years that were transitional governments, but this coalition is a fairly new effort in modern Greek history. Having been there 2 weeks ago and met with the leadership, I must say I'm quite impressed with what they're doing. They are rebuilding, and it's going to be a long and slow process, credibility with European leaders, with global markets, but most importantly, I think they're beginning the process of rebuilding credibility with their own citizens. Unfortunately, the strategy which Europe is pursuing today is not, in my view, a sensible strategy to help Greece move past this difficult period. You heard earlier this evening Kostas Karamanlis say that the Greek economy has contracted some 20% by the end of this year over the past 3 to 4 years. This is not because of lack of fiscal adjustment. It is in part because the pace of fiscal adjustment has been too demanding. Now, surely Greece needed to cut its budget deficit. But I've been involved in sovereign debt crises since I was a young man, and that's some years now. For over 30 years since I left the Fletcher School. I walked out of the Fletcher School, I walked into the Treasury Department, and someone handed me a government passport and a ticket to Mexico. 1976. Young man, you've got your first sovereign debt crisis. Little did I know that 36 years later, I'd still be working on sovereign debt crisis. But the reality is that I've never, in that entire 3.5 decade span, see an economy adjust its fiscal deficit over a 2-year period by 12.6% on a cyclically adjusted basis. When I put these numbers out earlier this year in a speech in Hamburg, you could have heard a pin drop. And one gentleman at the back of the room interrupted me in the middle of my speech and said, "Mr. Dallara, would you check those numbers?" I said, "I'll be glad to check on what I already have." And indeed, contrary to conventional wisdom, Greece has performed a near heroic feat of getting its fiscal deficit under control in an extraordinarily short period of time. This, in my view, is not just a testimony to what these governments have been able to accomplish, but also a testimony to the resilience, the fortitude, and the courage of the Greek people. People who have made considerable sacrifices and, despite fatigue, have shown resolute determination to rebuild their country. But this determination will not be endless unless Europe and the global community can show Greece that there is light at the end of the tunnel. When I was in Athens 2 weeks ago, 12 days ago, I guess, in the Prime Minister's office, he took a phone call. The call was from his finance minister reporting to him the latest economic growth data. Well, there is no economic growth data. It's economic contraction data. In the latest quarter, the Greek economy contracted at an annual pace of over 7%. No modern society and no modern democratic political structure can sustain that pace of contraction for too long without fragmenting at the very heart of what makes us advanced civilizations. The forecast for next year, on which the recent Brussels announcements and decisions were based, forecasts a growth next year, or a contraction, I should say, in the Greek economy of 4 to 5%. If indeed this occurs, the social strains come a year from now are going to be nearly unmanageable. What we need is a European leadership, in my view, supported more actively by the international community, that recognizes the need for a more measured pace of economic adjustment on the fiscal side, while the structural reforms that, as Kostas Karamanlis said, will be ultimately the way forward for revival of the Greek economy, can move forward. Greece has failed under these governments to adequately advance the privatization agenda. Greece has not reformed the tax system the way it should have these last few years. Greece has not forcibly liberalized its economic structure in a way that is going to be essential if the entrepreneurial and educational attributes of the Greek people are to be allowed to blossom and create a new competitive economy. Greece has regained external competitiveness. In fact, remarkably, largely because of wage compression at home. Greece has now more than fully reversed the 27% loss in external competitiveness that it experienced in the first years after adopting the euro. But you cannot regain competitiveness endlessly on wage contraction. There needs to be an adaptation, a more measured pace of fiscal adjustment, combined with a more intensive effort to structurally reform the Greek economy, supported by Eurozone investment funds. Last night, the Eurozone leaders met again in another of their seemingly endless series of partially successful but never quite clearing the air meetings that they have in Brussels, and I participated in more than my share of them over the last 2 years. There was a mention en passant in the announcement that was made, which was largely, by the way, quite a positive announcement, and I want to come back to that, but there was only a brief mention of accelerating the disbursement of investment funds. This should be one of the highest, if not the highest priority of Europe today. There are roads waiting to be repaired and built. There are ports waiting to be refurbished. The plans were on the drawing board at the time the crisis hit. I have investment bankers that I could get to go in and work with Greek bankers, including the gentleman who was supposed to be here tonight with me, the CEO of the National Bank of Greece. And they could repackage and restructure those loans, those credits within 90 days to get infrastructure finance moving in Europe. But it takes a real commitment from the European Investment Bank and the Eurozone authorities. And this has not been there to date. It takes a real sense of conviction as well that Greece not only should remain part of the euro, but will remain part of the euro. When I was in Greece, I had the opportunity to meet with 10 leading businessmen and women. And just as you read today about American CEOs saying that investment here is being hindered by lack of political clarity, in Greece it's very clear that businessmen and women are hesitating to invest, not just Greek businessmen and women, but European and global investors, because of exchange rate uncertainty. It's time that Chancellor Merkel and all of her colleagues put a clear end to the debate over Greece's future in the euro. A Greek exit from the euro would not be just a calamity for Greece. It would be a catastrophe for the global economy. And I think put us back in a position similar to the way we felt in the fall of 2008. I've never gone through a period of 3 to 6 months where I felt like the global economy was in such disarray and free fall. And I don't want to experience that again. I don't think any of you do. If we don't, let's stop the bickering and the debate in the corridors of parliaments and executive offices from The Hague to Helsinki to Berlin, and let's reaffirm once and for all that what needs to be done will be done to maintain Greece's presence in the euro. The path can be adjusted without enormous additional funds on the part of Europe. What we're talking about is not moving away from fiscal adjustment, but instead of taking 4% of fiscal deficit, 4% of GDP out of the fiscal deficit every year, if you move that barometer down up 1.5% to 2%, as Europe has been doing very credibly with Ireland for the last 3 years, one could then see signs of renewed life in the Greek economy. It's very unfortunate that the approach toward Greece and to a certain extent other southern European economies, in contrast to the approach toward Ireland, has been one characterized a bit, as Costa said, by the notion that there are saints and sinners in this world. In the Sistine Chapel, you have on the ceiling the marvelous, stunning creations of Michelangelo. But you also have on the northern wall of the Sistine Chapel a subsequent creation of Michelangelo, painted a few years after the ceiling. It's a rather striking painting because it covers the entire expanse of the wall. Most tourists don't focus on it and they're not told about it because it is a picture of two sets of figures. Half of them are floating to heaven and half of them are descending to hell. When I first saw the painting, I said, is that Michelangelo's creation or is that an image of Greece by Minister Schäuble? With all respect to the German finance minister, that painting captures a sense of how some Europeans view Greece today. But my 30-plus years of experience has taught me that if you try to find solutions to serious political and economic problems through moralizing, that you will not find those solutions. Yes, Greece did a lot to dig its own hole, but so did the investors of the world, so did those who created this marvelous Eurozone structure. And we must all work together to help Greece find a way out of this. I do see a real sense of determination when I'm there, and not just by the leaders. I think the political leadership of Greece has been shaken to its core. They were virtually thrown out on their heads by an upstart party that in my view was largely irresponsible, but captured nearly, 27% of the vote. Now, if that wasn't a wake-up call, that was not just a wake-up call for PASOK or New Democracy. That was a wake-up call for an entire generation. Forgive me for saying this with the clarity that I do. It was a wake-up call for an entire generation of Greek political leaders. And I think they've heard it. I've talked to most of them since then. I think they know that they have a long way to go in rebuilding their credibility with the Greek people, and they're determined to get there. And the recent votes that you've seen in the parliament, imagine an economy that has contracted almost 20%, and they're voting for another round of budget austerity? Imagine an economy in that difficult to shape, and they're talking about downsizing the role of government and getting rid of government jobs. And they're voting these things through Parliament with a real sense of determination. What Europe decided to do last night, in my view, was an important step forward in support of Greece. But they will need to do more. And as I mentioned earlier, it's about time that the United States and the IMF came into this effort in a big way. You know, when this crisis first erupted, for a period of time, European leaders became their own worst enemy because they said, we can manage this. We don't need the IMF. We don't need the United States. We don't need China. Go away. Leave us alone. That was a mistake. After a year of that, they started reaching out to the IMF. But still, the IMF's commitments and the U.S. ambivalence is a part of the problem. The European sovereign debt crisis is a global crisis. We should not fool ourselves into thinking that if this goes on unresolved, that the global economy will simply come back to chugging along at 3 to 4%. It will not. I've seen the kind of approach that Europe is taking, an austerity-driven approach with money handed out in modest sums in a very reluctant fashion. I've seen that approach before, and it doesn't work. During my time in the U.S. Treasury in the 80s, that is the approach we tried for some years with Latin America. We made a big deal of lending them sums of money, 90% of which they turned around and gave back to us to pay their debts to the banks and to the official creditors. That is what is happening today. The bulk of money that Europe is lending to Greece is being returned to the northern creditors. That's not going to be a solution that works, particularly if it is pursued in the context of a contracting economy, 4 to 5%. The amount of interest Greece is paying each year on its relatively small IMF loans is funding the entire operational budget of the IMF. Imagine. The reality is that in the 1980s, we realized early on that in order to resolve the Latin debt crisis, we would not be able to fund this directly out of the U.S. fiscal accounts, but we had to fund it through the accounts of the IMF. Why is that? Very simple. If you try to push those kind of foreign aid programs through Congress for every disbursement, every tranche, it simply won't work in a modern democratic world in which we live. Imagine if all of the loans provided during the 1980s to Mexico, to Brazil, to Chile, to Colombia, economies which are generally doing quite well now. Imagine if all of those loans had to be approved disbursement by disbursement by the U.S. Congress. That's the equivalent of what Europe is trying to do today. It's such a highly politicized, highly charged process that is simply not going to work. If many of these funds were being channeled through the IMF, as we did in the 80s for Latin America and in the 90s for Asia, we could depoliticize the environment in Europe and get on with the business of economic reform and renewing growth in Europe. There is, at the heart of this, an ambivalence by the U.S. It's Europe's problem, so we're not going to push the IMF into this. And an unfortunate tendency of IMF leadership, Christine Lagarde, to want to bend over backwards to demonstrate that she's really not a European running the IMF. She's a global leader. Fine, be a global leader, I would say, but do so in recognition that the most serious fire you have burning is in your former backyard in Europe. What possibly can the IMF do with $400 billion plus that they raised earlier this year? Sitting there, what possibly better use can they put it to than to use it today to support Europe? The problem of a contracting economy is not just one of Greece. I've been in Rome and I've been in Madrid recently, and I am very troubled by what I see there, particularly in Madrid. The economy is shrinking. They're trying to follow the same path of fiscal austerity, which has been prescribed for Greece. And just as in the case of Greece, the path is not working. So in the end, I think Europe and the global community have a choice to make. Either they can continue to pursue a path which seems to be based on the premise that these problems are going to be solved by endless doses of austerity and funded through a highly politicized European process, or they can try to find a global solution that is growth-oriented. That is what we eventually did in the Latin debt problem in the late 80s when we developed, under the leadership of a good friend and my former boss, Nicholas Brady, the so-called Brady Plan. The Brady Plan was nominally about debt reduction, but at its heart, it was about renewed growth and hope. And that, I think, is what Greece and Europe needs today. Let me close with a brief quote from the gentleman that we are honoring here tonight, a man who was dedicated for much of his life not just to building a functioning democracy in Greece, but to ensuring that Greece would be part of Europe. And I think some of you know better than I do that it wasn't centuries ago, it was only decades ago when the future of Greece in Europe was a big political issue. Today it's a big economic issue. But we should not have short enough memories that we forget how troubled, politically troubled, the path of Greece was in the middle part of this last century. Speaking on the signing of Greece's ascension to the EEC, EU in 1981, Konstantinos Karamanlis said, and I thank this courtesy of my colleague here at Fletcher, Georgia Komandoras, who maybe it was serendipity that when I agreed to work with Fletcher to mobilize some fundraising a few years ago, that they found a Greek American to work with me, knowing maybe that I would end up spending so much of my time in Greece. But Georgia found this quote today from former President Karamanlis, which I would like to leave with you. From today, Greece accepts once and for all the historic challenge, her European destiny, without losing her national identity. Think of how important that balanced symmetry is, a European destiny without losing national identity. If more leaders in Europe today had confidence that they could forge European destiny without losing national identity, I think we would all be better off. He goes on to say, we have confidence both in Europe and in Greece. We have resolved that we will be all Europeans, as Churchill would say, and all Greeks, as Shelley would say. Thank you for your time this evening.
I think that everyone agrees that Charles Dallara, when the things he said will be transmitted to Greece, will be highly appreciated. But in the meantime, we can perhaps talk about points he has raised. If you have any questions, we have some time ahead of us, and you can probably come here, step forward, and ask a question or say something with a question mark at the end.
Thank you for a nice talk. Could you please describe the Brady-Dallara plan for Greece, how it could be?
Well, I think some aspects of what I think should be a Brady-Dallara plan for Greece are already quite evident. I concluded some 2 years ago, and after long discussions within Prime Minister Papandreou, that Greece needed major debt reduction from its private holders of Greek debt. And that we have accomplished. 53% of the debt in private holders' hands has been wiped out, and another 37% has been stretched out over 30 years. But what is missing in the Brady-Dallara plan for Greece are the structural reforms and the pace of fiscal adjustment that is needed to restore a sense of economic momentum and growth. All of this fixation about debt to GDP ratios in 2020 are largely a distraction. Because if you restart growth, that sustainability will come to you like a boat moving slowly in a current. If you don't restart growth, all of debt reduction in the world is not going to put Greece on a stable path. I think the recapitalization of the banks is a key step here. And one of the most important things that was done last night was to recapitalize the banks so that they can start lending to Greece again. But it's clear that this is going to take some time. I think that what we need now, though, is a rebalancing of the adjustment process between fiscal austerity and structural reform, supported by renewed investment by European agencies in Greece, which will then catalyze private investment.
Yanni?
Yanni Tufts University. I'm tempted to say I'm very glad Dr. Dallara that really the only sensible plan for the future is growth. But one remark, it seems to me from reading the official documents, the predictions for growth are relatively modest. So more effort has to be done that way. And I think the other part that's been talked about, and I really like your opinion on, is the official sector involvement. Don't you think that politically that's a very hard thing to accomplish at the present juncture?
It is a very difficult thing. And I have refrained from pushing it in quite the explicit way that Kostas Karamanlis did, although I wouldn't necessarily disagree with his sentiment. What I think Europe needs to do is a combination of three things. Cut the interest rates to the bone on the loans that they're making to Greece. Now, they did take some important steps in that direction last night. They agreed to cut some of the interest rates. But if you read carefully the text of the announcement that came out of Brussels last night, I was a bit deflated when I read that they're going to defer the interest payments for 10 years on some of the new loans. They're going to capitalize them. It will remain a burden on Greece's balance sheet. It will just be pushed down the road. They should be just cutting the interest charges down to the cost of lending. And the IMF should be doing the same. This debate about official sectoral involvement, which has been stimulated by the IMF, is a little bit strange in the sense that the IMF thinks that it should be outside the scope. There is ample precedent in the past for the IMF to lend funds to its members at highly subsidized rates in exceptional circumstances. And if Greece is not one of those circumstances, then I don't know what is. I sat on the board of the fund for 5 years. I don't accept the argument that the IMF can't adapt its interest rates. It can. It just has to have the political will and the leadership to do it. I think that asking the European governments to actually write down their loans to Greece at this point, however, may be somewhat counterproductive. I think there may come a point down the road when that can be put on the table again. But I think that today I would emphasize increased lending by Europe, especially investment lending, a slower pace of fiscal adjustment, and cutting the interest rates. And that includes the interest rates from the ECB. I don't find it very acceptable at all that the ECB is still not cutting the interest charges it charges Greece down to concessional terms. The ECB is a special institution and it has special rules. But everyone in Europe must contribute to the solution of Greece's problems.
The gentleman here.
Thank you so much for your talk. A couple of questions, mostly related to. Is it better now? Thank you. I have one question related to a comment that you made about failing of Lehman Brothers being one of the 5 bad decisions of the century. Do you also think, given you've alluded to structural challenges at the formation of euro, that also being one of the 5 bad decisions for the economy? And secondly, your point about reducing the interest rate and then providing investment, does that create some kind of a moral hazard for the world economy? Other economies will probably, again, economies that are struggling, might also expect the same terms.
Well, I think, first of all, it's an interesting question. Will we look back on the creation of the euro as a major policy mistake? I see it in a different light. It is certainly a flawed decision, but I think it's one where the flaws can be corrected. And I think that's why it is important that Europe moves steadily toward integration of its fiscal accounts and eventually ceding more and more authority to a common authority. Now, I know this is very difficult, and right now, at a time of European recession, many governments are not inclined to move in this direction, but you do see movement toward what they call a banking union, which is really not a banking union at all, but it's a common framework for banking supervision. You do see some movement toward a common set of rules for fiscal policy. And I think eventually progress in this front can address the underlying flaw of the Eurozone. But I think it's important to recognize that it was a flaw. I view the Lehman decision as just profoundly bad decision-making. I think it's a different nature. Lehman did not have to fail. The world economy did not have to go into a tailspin. But it did, because the U.S. government decided that it was not going to support Lehman. It was a calculated risk. Now, would I have preferred that the world deal with a little more moral hazard? Absolutely. I think the moral hazard argument is one of the most inflated arguments of the last 20 years. What government is going to be encouraged to follow policies that lead it down the path of where Greece is today? Let them go spend a few days in Athens. They'll find out what it's like to be in that part of the sea. I think moral hazard is a real issue, and I don't mean to be quite so dismissive of it, but I think it's a greatly exaggerated issue by creditors who have other reasons sometimes why they don't want to do things on behalf of debtors.
Last week you said that you were at the Prime Minister's office in Athens 12 days ago. Can you give us an opinion, your personal opinion, about Mr. Antonis Samaras? And do you feel that he's the right person that will get Greece out of this crisis?
I'm impressed by what he and his government are doing. As I said, I had a sense in meeting with him as well as other governmental leaders there that, and I don't mean here in my response to personalize this on the Prime Minister, but I had a sense that the political class of Greece knows that they have let the Greek people down. And I sensed on the part of the Prime Minister and his coalition that they're determined to regain the trust of the Greek people, knowing that that is a bit of a long road. And I must say, if you had asked me in the spring of this year if I thought a coalition government of this nature would be able to pass through Parliament two exceptionally difficult sets of legislation, I would have probably given you pretty long odds against it. So I think we have to be pretty impressed with what they are doing under the leadership of the Prime Minister, as I was, to be honest, under the technical government of Prime Minister Papadopoulos. It was not an easy time for him, but I think this government has earned an opportunity to see if it can deliver for the Greek people, and I hope that they will be given enough time in government to see if they can follow through on this aspiration.
I was very pleased to hear Costa and you both refer to the necessity for structural reform, and I'm wondering if there's a voice, a cogent voice, perhaps an organized voice within Greece and in the circles in which you in Europe travel for structural reform, perhaps a well-thought-out list being developed so that that voice, although diminutive now, it can somehow sway the debate and help Greece recover, because I've always felt that that was an essential starting point myself.
Well, I'll just say I agree with you. I would like to work with the Greek leaders today, and they are more determined to move on privatization than any government I remember in Greece. And that's encouraging, because I think privatization is symbolically and structurally very important for Greece. But I also see a willingness now to finally tackle some of the other barnacles which have really weighed on the Greek economy over years, if not decades. And I'm working now with some of our investors, business leaders, and some of the leaders in Europe who I think are beginning to realize that this is not all just a fiscal adjustment game, but unfortunately that seems to be the mentality still in some of the capitals.
The gentleman in the middle.
Thanks. Thank you for your talk. You mentioned your time at the IMF and the Treasury and how the US tried to use the IMF to channel funds into Latin America in order to bypass Congress and everything that meant. So this is a question about interest rates. Given that many other European Eurozone countries are borrowing to lend to Greece, and they're facing interest rates that are in the order of 5% in case of Italy or more in the financial markets. Do you think it's politically feasible to get a reduction in the interest rate that Greece is having from those loans?
Well, they did show some movement last night in reducing the interest rates on some of the loans. But one of the elements of political feasibility is understanding how to use the global instruments that you have. We created a global institution 60 years ago. We call it the IMF. It is the only multilateral institution of its nature whereby the funding does not actually get charged back to national government budgets because of the technical concept of an exchange of assets, which I will not bore you with at this time in the evening. The key here, in my view, is to disengage a little bit the economic reform process from the politics. And one way of doing that, of course, is to streamline some of the governance and decision-making of Europe so that every time they approve one disbursement for Greece, it doesn't have to go back through national parliaments, which is an absurd way of running things, to be quite honest. But another way of doing this is to channel more of the funds through the IMF, where they're approved by a technical board. You shouldn't ask politicians time and again to have to vote time and again for substantial amounts of this kind of programmatic support. They don't want to be put in that position, but when they are, it's going to inevitably be difficult. And so I think there needs to be governance change and more funding channeled through the IMF.
Last question here.
I come from Bulgaria. Bulgaria had a very difficult period in the 90s, and I'm sure you had a closer look than I would be able to explain now. But thinking about the changes and the lessons of the Greek crisis and the crisis before the Greek crisis and possibly the crisis that would follow, would you see in your 30-plus year career a development in a human-sensitive leadership that would care about how people would accept difficulties and how they would be motivated intrinsically as well to go through those difficulties so that their countries and their societies develop? And could this experience also help other parts of the world, such as Africa, for example, where they don't even have the infrastructure yet to deal with some of the instruments the IMF might have developed for them?
Well, I think it's a perfect topic for a new Fletcher course, isn't it? Because I think you've touched upon so many challenging issues. How do you prepare societies to go through such difficult phases like this? I don't know of any straightforward and simple way to do it. I do think that in the end of the day, the one beautiful thing that we have going in many of these countries, not all of them, is the functioning of democracy. Those elections in Greece were important signals to the Greek leaders, just as they are in many countries, that you don't quite have your act together. And I think that if we continue to deepen our understanding of how to use the process of democratic governance, that we're going to move ourselves in the direction toward which you aspire. But we probably need a few courses to help us get there.
So unfortunately, we have come to the end. Let me thank Charles Dallara again for his a splendid talk, and as a small token of our appreciation, give him this small gift. Thank you very much.